bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the March 17th, 2026 episode. As our audience on YouTube can see, my guest this week is Stephanie Naquin. Stephanie is Novogradac's Director of Multifamily Compliance. She's based in our Austin, Texas office. Let me actually take a moment to brag on Stephanie. Many of you may know the National Association of Home Builders recently announced, those of you that aren't watching YouTube can't see Stephanie starting to blush a little bit. They recently announced that Stephanie Naquin is the 2025 Housing Credit Certified Professional of the Year. That's HCCP of the Year. It's a prestigious honor that NAHB uses to recognize someone's outstanding leadership, expertise, and contributions to the affordable housing industry. And as I know, my audience believes there's nobody more worthy of that distinction than Stephanie. So congratulations, Stephanie.
Thank you. I don't know if it's good or bad that you did not know that was coming. Thank you. Thank you so much.
You're very welcome. And
very much an honor.
Those in our audience that listened to last week's podcast heard me give you a shout out at the end of the episode as well. And you're one of the few Novogradacs that have gotten a shout out on Tax Credit Tuesday. So you're in a select company.
That would be on par with the HCCP.
So back to the episode. Stephanie is back on Tax Credit Tuesday to discuss the most common compliance errors for LIHTC properties that her team sees, and more importantly, obviously, how to avoid them. Now, the list of common errors came out of a survey that Stephanie conducted of Novogradac team members. This survey and the results of the survey formed the basis of an article on the topic in the March edition of the Novogradac Journal of Tax Credits. And I will include a link to that article in today's show notes. So rather than give any more sort of introduction, because we have a lot to discuss, and I want Stephanie to be describing the survey in more detail in a moment. So if you're ready, let's get started. So Stephanie, welcome back to Tax Credit Tuesday.
Well, thank you for having me back. I very much appreciate it.
Thank you. This is, in case you're not counting, your 12th appearance on Tax Credit Tuesday. So we'll look back to having you back soon so you can have a baker's dozen of appearances.
You made the dozen before I could, and I was just...
And your last appearance was nearly a year ago for an installment in the Tax Credit Tuesdays podcast, So You Want to Be a LIHTC Developer series. And that was an episode that covered tips to stay compliant when a property has to qualify tenants for multiple affordable housing programs, which generally means follow the lowest common denominator. Mm-hmm. However, many have not heard you on the podcast before, I'm sure, of our listeners. So before I jump into the topic of this week's podcast, please describe to my audience some of the services that you provide to Novogradac clients.
Absolutely. So here at Novogradac, my team is all compliance. I might play an accountant on TV every once in a while or an attorney on a podcast, but we stay on that game until, crosses one non-compliant means to impact your credit delivery. So we're all compliance professionals. Day in, day out, my team is looking at hundreds of tenant files across the country for various reasons. Now, whether that be for pre-occupancy approval reviews or first-year tenant file reviews for investors, we really have a fantastic opportunity to tap into a large breadth of work to get a good understanding about what these common findings or violations rather, that we're noting through these different types of processes. And so not only in addition to tenant file reviews, we do a whole bunch of tenant file consulting or multifamily compliance consulting. I myself do consulting directly with owners or state agencies or investors, and my team does more of the day-to-day tenant file compliance review work. So we really got to get to touch it all in the affordable space when it comes to compliance. Today's conversation is going to be focused very much on the LIHTC world, right? The world under Section 42. But we tend to touch all sorts of affordable housing programs. So my prior appearance on this podcast is where we've talked more about some of the various types of programs. And so while we're going to be talking LIHTC specific today, we also touch on all affordable housing programs across the country, local, national, federal, state, whatever you want to call it. If it has a regulatory agreement and some rules, we got you. So in a nutshell, that's what we do.
No, thank you for that explanation. I also appreciate you emphasizing the fact that we're going to be talking about luxury tax credit compliance here, but you work in all the other areas from property tax, so on and so forth. So if others have other programs they're interested in having some tenant file reviews, please reach out to Stephanie. Now, as I noted in the introduction, this episode is inspired by the survey that you did and the column you wrote about in our March issue of the Journal of Tax Credits. And that article focused on a survey that you gathered where you reached out to Novogradac compliance professionals throughout the firm and asked them about the most common compliance errors that they find in reviewing tenant and other compliance files. So maybe we start by you sharing with our audience the reason why you conducted the survey and what your goals were with the survey.
Sure. The original purpose of the survey was I was interested in seeing what the team was observing so that we could internally figure out how to best tackle those issues in the most succinct way. And in doing that, it really kind of illuminated that there was a commonality that I thought would be of benefit to share with folks. And so said differently, because we are working with so many different investors across so many states, doing these first-year tenant file reviews that have this very high level of rigor that has to be met, we had such an interesting ability to tap into our experience. And I thought we were going to see more one-offs, more like random things that one person happened to be seeing. Because I was trying to get an understanding of, was this person always fully identifying this stuff over and over, or was this more of a global thing? So that was the reason of the survey. And then through the survey, I thought it was important to share it with folks. And I think the surprise out of the survey, like I said, was the commonality of it. My ability to really take people saying something in their own language, but saying the same thing, and they synthesizing it into categories. And when I did that, I was like, oh, wait, this is something other folks should know that we are seeing. Because if we're interested in what we're seeing and how do we navigate through that, other folks surely would be interested in that. See what we're saying to get ahead of us seeing.
Well, I think our audience is now thinking to themselves, okay, thank you for doing that survey. And you mentioned that there was a commonality of violations or of errors or the like. So what were the categories or the key areas where there was a commonality in terms of errors or violations?
So the way that I think the survey unfolded is that there were definitely issues or violations that we observed because of certain state policies or state regulations. And we can't ignore that because, as we know, everything under Section 42 flows through the state agency lens. That's really important. But it was the more specific things that we were seeing that were the nexus for that, I think, was what was interesting that came out of the survey. The second one really had to do with, and this isn't going to be a surprise, is the calculation of income. But it was the actual examples that the team was expressing that I was like, that's interesting. We're talking about fixed income or earned income like employment. And then the last two I saw were one had to do with changes regarding HOTMA, right? So HOTMA is the Housing Opportunity Through Modernization Act, which was introduced back in 2016. And we're all still trying to figure out how to implement HOTMA here in 2026. But that's a real struggle. I mean, it is creating some issues. And so we're going to talk a little bit about that. And then lastly, errors we were seeing with forms that are being used. And that includes the tenant income certification, the dynamic process that the review process of a tenant file review has an impact on with these forms.
So thank you for that. As you expressed it, I think you are breaking out into 4 categories. And if I'm recalling correctly, number 1 is misunderstanding. state requirements. Number 2 being errors in the calculation of tenant income. Number 3 being the failure to apply or at least to properly apply HOTMA requirements. And thank you, by the way, for your leadership with HOTMA over the years.
Giant.
And then number 4, using the wrong forms or completing the forms incorrectly. So the 4 categories as you see them.
That's right.
Okay, let's jump right in. We'll go one by one.
Yep.
So let's start with number 1, misunderstanding state requirements. What were some of the common misunderstandings so that those in our audience can be aware and let their property managers or asset managers or the like be on the lookout for these common errors or misunderstandings?
So before I jump into this, to the state agencies listening, I just want to send my deepest respect to you guys out there. It seems like a whole nother life ago that I used to work at a state agency. It was the director of compliance of the Texas allocated agency. So I have a unique understanding of how challenging it can be to maintain the right balance of compliance monitoring requirements that are specific to the needs of your state. That said, one of the challenges that we tend to see in state agencies changing their compliance requirements without either clearly communicating that the change had occurred or effectively communicating when that change occurred. So said differently, they could have a requirement to do X, Y, Z, and at some point they change it to A, B, C without an understanding of when that change happened, which makes it really hard to apply what the correct provision is based on the correct date of the effective date of the tenant income certification. And that was a real challenge. And that does a little bit feed into the HOTMA piece of it all, because we are dealing with a rolling implementation. And so I would say that, especially during this time period, that became more of a challenge because we were dealing with quick changes in state agency roles and requirements, but that weren't clearly communicated in a way that we were able to catch them as quickly as we would have liked to, which if we're looking at it after the tenant's already moved in, that's not the time to be catching those things. And so really trying to figure out how does a state agency effectively communicate when these types of changes are made. So that's one of the things that I saw was an issue. So like we were saying XYZ was a violation, but really state agency had changed their policy or the inverse.
Yes.
Not creating an unnecessary back and forth. Second, or related to actual verification requirements. And so again, like each state agency says, hey, if you're going to verify employment in my state, you have to do X, Y, Z. You must do it this way. If you don't do it that way, that's a problem. And so just a misunderstanding of what that is, like while this isn't uncommon, the fact that we were still seeing it as a common error was a little like, and so just reinforcing, we need to keep our eye on how does this state we say we need. We understand what the minimum is required federally. It doesn't mean that's how that state is done. And then timing of verifications. And again, that kind of goes back up into the higher idea of the income verification. Does the state limit things to 120 days? Do they allow things outside 120 days? Understanding that is a big deal because there are states out there that would allow verifications to live outside that 120-day verification window we're accustomed to, and there are states that don't. And applying that incorrectly really puts us in a sticky situation when it comes to income eligibility. And so just in general, those are the kind of things we've seen with like state agency policy.
Now, would you say it probably goes without saying that in part that's because those developers, property managers, asset managers that are working with properties in multiple states just aren't as in tune to the nuanced differences across states?
Yes. That would be the answer. Yeah.
No, thank you. No, I appreciate, obviously. That's a remarkable answer to that.
And I'll just say too, when I often had conversations with folks that are like, we've done the review and I'm on the phone with the investor and they're like, well, what happened? And I'm like, the magic we performed here is before we picked up the review, we double checked to make sure we had the right conditions in place to undergo the review. And this is the result of that. And so it's fortunate and unfortunate at the same time, but it takes a level of diligence on the onset that when you're doing it day in, day out on site, it's not necessarily something that you would think about doing because you're not thinking of the state changing its policies every 3 months or something, right?
No, that's right. There's definitely the whole notion of state safety policies and implementation. It reminds me of years ago of a property that the utility allowance ended up changing multiple times during the year,
Mm,
and they weren't adopting the change as it was changing.
fun.
I won't go down that rabbit hole, but it was the same sort of situation where they weren't constantly monitoring the potential of certain requirements changing.
Yeah.
So let's go to number 2.
Okay.
And as you noted, calculation of tenant income was one of the areas of error, which I doubt that comes as a surprise to many in the audience because that does have a lot of complexity to it. But please expand on what your survey showed about some of the common ways in which the calculation of tenant income was an error.
So again, these things that were reported aren't unusual in the sense that they aren't things that wouldn't be of a surprise. What was the surprise was that I don't continually to see these, continually to see these.
And I'm certainly not saying that the fact that it wasn't a surprise means you don't need to worry about it. You always have to worry
That's
about
right.
it a lot.
Always have to worry about it. In fact,
So
we
it's only
need to
not a
have it
surprise.
more because it
It was only not a surprise because calculation of income has such complexity to it.
yes. But it was per se where things were complex that we were seeing errors.
Interesting.
Actually, the inverse. So we
Okay.
identifying pay frequency. It's like saying it's biweekly when it should have been 24 as opposed to 26. Like literally just multiplying we see
Interesting.
a bunch of that. And I'm seeing an uptick in that, which is a little bit weird. Incomplete employment verification forms. There's some states out there, so tying back up to the state requirements that require that kind of old school third party employment verification form that you dust off your fax machine, you fax over to the employer. There's rules for
A
that.
fax machine?
I know, yeah. There was to fax it, and then you got to fax it back, and it's going to be printed out on the duplicate paper. No, I was kidding, I'm aging myself. But yeah, they still require that sort of method. They're not faxing it these days. I just like to jest about the silliness of the type of verification. But there's a lot of things on that form. And if you're going to ask the question, those need to be completed. And just not following the verification all the way through. And blank don't mean it doesn't exist. It means the question isn't answered, which puts someone who's reviewing the tenant file in an impossible position of recalculating someone's tenant income. We also see an increase in the rate of pay. So, for example, we get 4 paycheck stubs, and in the last 2, they show that their hourly rate increase. Well, it's not because we're always taking the most sort of circumstances. It wouldn't be appropriate to weigh the average down by that lower hourly rate. And with, I think, the volatility and just the market and employment market in general, we see rates fluctuate all over the place. So we're seeing rates increase and decrease. And in absence of clarification, that creates a real issue. So that one is a little bit more, I think, prevalent these days because of the nature of the employment market. While it's always been something that people had an issue with, but I think now because people are changing positions, their rate of pay seems to change more. So those paychecks may be focused on a little bit more detail. And then the last, if I'm thinking about paychecks, is missing supplemental pay. So for example, I get 3 paycheck stubs and it has just straight regular pay during those 3 paychecks, but year to date has a bunch of commissions in it. And those commissions weren't paid out in those 3 paycheck stubs. Maybe they're paid out in that 4th one in that quarter, or maybe they're paid out separately, not accommodating for those supplemental pay in the right way. It's increasingly becoming an issue. And this is really important because people's response to this sticks is to calculate what's called a year-to-date calculation. And that is not something I want to push as an industry.
Right.
It's not an accurate representation because it pulls out past information in ways that year-to-date in a weird way. And so I think what folks need to really be focusing on is what is the information on these documents. And is it the complete story? Do I have enough to calculate the income? That's employment income. We also have fixed income, and fixed income is things like Social Security, supplemental security income, VA benefits, retirement, all those things that you're getting a regular amount every month. Some of those increase with what's called the cost of living adjustment. So, Social Security Administration puts that pull out every year. We know all benefits of Social Security, they ought to qualify also the VA benefits, but does it apply to other fixed benefits? And then the verification requirement of certain fixed benefits has become more and more important as folks are rolling HOTMA out. Said differently, if someone just gets regular Social Security, their annual benefit award letter is sufficient. But if someone is getting supplemental security, Social Security income, that can fluctuate. And so that verification has to be current. And those are two different procedures to apply. So if someone gives me, or us rather, a Social Security SSI verification that's not within the right date frame, that is a problem. And a lot of times we hear, well, Social Security doesn't change. I'm like, no, that's a different line of fixed income. You have to make sure you're meeting the verification requirements based on each fixed income source.
Great. Thank you for that. Anything else on the cognizant tenant income, or should we move on?
We can move on.
Okay.
I could pick them all today. This is supposed to be the heavy hitters.
No, I'm glad you're getting the high points and the most common of the errors to capture them most situations. So number 3 that you had listed out was the failure to apply or properly apply HOTMA requirements. And I can't even think now how many years you've been addressing the HOTMA requirements coming.
Yeah, because I thought it was coming. I was all ready for it.
Yep. And now you're dealing with the failure to properly apply them.
And you're right. Yeah. So the HOTMA was first introduced back in 2016 with the implementation notice released like fall 2023. We all thought starting January 1st of 2024 it was going to be HOTMA. Well, it's 2026, guys, and that's not happening. So what we are seeing is states that got on board. And I'm not going to talk a lot about why HOTMA applies to Section 22, because, why it's a HUD program. Why are we talking about HOTMA in this regard? We did a whole podcast on that before.
Yes, we did.
And welcome folks to go back and check that one out. But it does affect how we determine income in our universe. And what we are seeing is two things happening. First, states not fully rolling out all the HOTMA changes or allowing owners to pick and choose whatever HOTMA compliance changes they want to implement, which becomes even messier if you're thinking about changes to state agency policies. They have their baseline policies and they have this other bucket that's like, hey, if you want to implement certain provisions of HOTMA, go for it. And that makes it really challenging to understand, is HOTMA in effect or is it not in effect? And so, we recently came across and did a first year file review, and I won't say the state and I won't say the property, but I'll just say the fact pattern. And the state hadn't fully implemented HOTMA, and they did allow owners to implement categories of HOTMA in different cadences at their discretion up until a certain time period. And so this particular owner took a category under HOTMA, and then below that category picked out things in that category that they were going to implement. And so where we were used to seeing categories fully implemented or not implemented, this owner picked individual categories. And that was okay with the state, but that was really hard to work through without someone communicating to us on the on-front that that's what they did and that was what was acceptable. That's challenging. I guess the other thing that we see is where states have implemented HOTMA, folks having a challenge with the application of how assets are now determined. So one of the things that HOTMA really fundamentally did was change what we recognize as assets for the purposes of what is income from the asset that I need to include in this household income. So it changed how we categorize assets. It changed when we started imputing income. But that change, what makes complete sense to me, is it's a little bit weird because it increases the imputed income threshold. It changes the pass-through rate. Those change from year to year. And so properly either including assets or properly excluding assets are things people are struggling with. And that's a problem. For example, HOTMA said, you know what? IRAs are no longer considered assets. Once they start paying out their income, they're no longer considered assets. Well, we have folks still verifying IRAs and then pulling that value into the total value of the assets, which of course on its face isn't super destructive, but it has a compounding effect to the larger set of assets. And so really understanding what is an asset, what isn't an asset, and then from there drilling down in the correct way. And so I would say when it comes to HOTMA, those are the two big ones we're still struggling with. I'll just throw them out there, and maybe this is another conversation for another day, but through the recent adoption of the HUD Appropriation Act, we're also going to see a change to how student financial aid is to be considered. And so look for that in a future journal article or maybe a future discussion here.
Great. Thank you for that. And then the fourth category is using the wrong forms or completing them incorrectly. And when we say using the wrong forms, are they generally old forms?
Sometimes. That's a great question. Most of the time, they're either an owner just didn't recognize that there was a form requirement, or
Okay.
they didn't recognize that there were things that were to be included in a form that they were creating. And that's different than the state agency putting a form out there and then putting out a new form, and
Right.
the owner knowing the form exists, just not checking for that new form. And so I always say both of those things occur probably at the same pace. But those required forms are a big deal. And I always say, even if a state doesn't have a required form, they have recommended forms. Those are forms that they have determined are appropriate for their program. Use them. Like there's no point
Exactly.
in fixing the wheel. No, don't take the risk if you don't need to. It's one less thing you have to think about. So, but really at minimum, understanding what are the required forms and how do they change. How here, the way that we tend to do it is we develop a really wonderful kind of compliance software where it allows us to set up state agency criteria with effective dates. And so that we can put the individual forms in based on the effective date of that. But to my earlier point, that takes some clear communication from the state agency on when those things become effective in order to properly apply them. So this is all a little bit chicken and the egg.
Yes. Well, thank you
Uh,
for that.
oh.
Anything that you want to say about the forms?
I mean, the rough thing I would say about forms is the tenant income certification, like that form, and states call it a whole bunch of different things. But you guys know if you've ever done a tenant file, well, you know the form I'm talking about. And it's the document that at the end of the process, so after the manager or the site staff has done all the application and verified all the things, they put it all together. They put it on what's called this tenant income certification form. And now from the household side, I said, yeah, that's me. That's my household. You got it right. Nothing's changed. We're on the same page.
Yep.
And part of compliance with what's the category that's household income below income limit upon initial occupancy. So that's a category that's reportable on the 8823. Part of what will trigger that is the household not signing that form. And so that's a big deal, not having that form signed. But the other thing is that form, I have come to look at it for the purposes of what we're doing for these investor reviews as a tax record, right? It's using to support someone's ability to take a reduction on their federal tax liability based on this tenant income certification. So the other thing that we tend to see is that through the review process, we may have issues with forms. We may have issues with a verification. We may have issues with an incomplete something or another. And once that is perfected, clarified, the supplemental information is provided to us, it changes in what is on that tenant income certification form. And there's an expectation that that form be perfected as those things move through the process of it. And so this was a common area that we would see in that we would call out a violation, a response would be received, and that response would fundamentally change what value was on that tenant income certification form. The folks were taking that extra step to correct that form, which meant we had to go back and forth again, which just delays the process unnecessarily. And so just knowing how the things that you're doing throughout this process impacts that final certification and what that certification means. Like coming from the taxes allocating agency, people and coming over to kind of this side of the fence, people are like, oh, it's going to be so hard for you to back off your state mind. It's going to be so challenging. And I got the opposite experience, actually. Like, as a state agent, I was so focused on, can I look at this file independently? Can I get comfortable there's enough here to support income eligibility? And if my answer was yes, that would have been a hot mess. And I would have never communicated that to the owner because I was able to meet what I was responsible to do under my obligations in state agency. And that's different, right, than doing these types of reviews where they want to make sure that that I is dot. I get it. That I has no effect on income eligibility, but because this is a first-year tenant file and because of its importance, there's a high level of scrutiny, and I had to come to appreciate those variations of what we're all doing in this industry.
Excellent. Thank you for that, Stephanie. Before we close, I always like to ask the guests if there's other resources that you recommend the audience follow or reach out for to learn more beyond, of course, reaching out to you directly via the show notes.
Yeah, just if your state agency has any listservs, sign up for the listservs. That's a way in which they can communicate that information to you so you can at least have that information on hand. If having someone in your shop that understands these intricacies and can make sure that you're checking for this on a regular basis. Trainings are important. Staying plugged into when your state agency does trainings. I see a lot of states who do a really great job with staying in touch with their partners. They do like lunch and learn series almost weekly. Like they do podcasts. They do all sorts of things to reach their partners. But if you're not plugged into their method of communication, then you're not going to know about all that cool stuff. So that's one way to stay informed. A training like Novogradac, we've always had a property compliance workshop that came with the Novogradac property compliance certification. This last year, we actually broke that out into 2 different workshops. We had one for a beginner, one for advanced, both of which come with their own certification. So that's really exciting for us because what it allows us to do is really take more time to focus on folks that are entry level into this industry and talk about how these different things can impact them and what they can do to avoid them. And that's going to look different than what folks that have been doing this for a minute could do to affect change. And so we're excited about those workshops.
Great. I appreciate all your efforts on behalf of those workshops. And then I also would just encourage the audience to subscribe to the Journal of Tax Credits and also think about our locally tax credit working group and our income element working group. But with that, let me say thank you, Stephanie. Please do stick around for our off mic section. Before we get to that, if you're a member of the audience and you're enjoying the podcast, which I hope you are, please be sure to subscribe to Tax Credit Tuesday. Also, I encourage you to share our podcast with your colleagues, as well as post on social media. If there's an episode you particularly like, please post it on social media. And if you can, just link me on the posting. On X, my handle is @Novogradac, and I'm easy to find on LinkedIn and other platforms as well. And if you have any issues or questions you'd like to hear on an upcoming episode, please contact us at contact@novoco.com. So now we've reached our off mic section where we get to give a shout out. My guest gets to give a shout out to others working in the tax credit and tax incentive communities. An opportunity to highlight a professional who deserves recognition. So Stephanie, who would you like to shout out?
Okay, so, and like the announcement of the HTCP thing, I'm going to shout out someone on that board, Patricia Hensley. She's the VP of Compliance at Kill, and I have known her for a bazillion years. We worked together at the Tax Allocating Agency, and we just kind of run into each other throughout the industry. She serves on that board, and she was, I don't want to say instrumental, but a real champion of mine during that process. And just to keep on that note of gratitude, I just want to send her out a note of gratitude for all of her efforts.
Great. Thank you. I echo your shout out. And Stephanie, congratulations again for being the NAHB HCCP of the year.
How many acronyms can we say at once?
And thank you for being on the podcast today. Hope to see you back here soon.
Thanks for having me.
And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.